Of Navratri in full swings in Mumbai. But then let's move on and let's talk about systematic transfer plans. STP helps investors benefit from potential returns of equity funds while minimizing the risk of lump sum investment. A systematic transfer plan allows investors to transfer a fixed amount of one mutual fund scheme to another at regular intervals. And guess what? It is actually that simple, the way it sounds. But what's the right process and what are the essentials involved here? Let's discuss all of this. With me, I have today Shweta Jain from Investography. Shweta, good evening and welcome to the show. And let's talk about systematic transfer plan. I'm sure people must have read about it, seen a lot of videos on social media. A lot of them must be doing it also. But then, it's always about getting the process very right, because a lot of time investors don't understand as to the kind of the way in fact they should be doing this STP, or phasing out their investment in the right way as far as the lump sum investment is concerned. So I want to understand the thought of STP. From where did it come? Because a lot of investors, either are timing the market. A lot of times they don't invest thinking that they need a lot of money to invest, which never happens. So what's the thought behind the origin of systematic transfer plan? If you could just start with that.
Hi, Kavita. Thanks for having me. The thought is quite simple. It's like an SIP, but for somebody who doesn't have the monthly income. For example, if it's a businessman or somebody who is an entrepreneur or a freelancer, right? So they don't have regular money coming in, not like a salary. So they might have lump sums coming in. So what do they do then? Should they invest at the time when there is lump sum? How do they stagger it so that the rupee cost averaging works for them? So that's the whole thought process behind STP. It's an SIP for somebody who doesn't have the regular inflow like a salary. Right? It is a very simple process. You invest lump sum money that you have in, say, a liquid fund, right? And from that fund, you give a instruction for an STP, a systematic transfer plan, to get into an equity. So you get the advantage of your rupee cost averaging. So for somebody who's received bonuses, for somebody who's won a lottery, whatever it may be, a systematic transfer plan works best for you when you're staggering that investment. So it could be staggering over 3 months, 6 months, 12 months, depending on your time horizon. Ideally, I would say if somebody has a lump sum and is looking to start something new, 6 to 9 months is a good time to stagger your investments. So you choose a liquid fund, and then from that fund house, the liquid fund will, in the same fund house, will move money, whatever you've requested, as a monthly or a weekly. So you can choose your periodicity as well into equity. Right. So the ideal way is to transfer from a debt fund to an equity fund. So that's what an STP is.
So I also want to understand the choice of funds one might, select. Also, I mean, I have a lot of questions on STP, but then let's just go one by one. Okay, the selection of funds. So you need to select a liquid fund where you park in your lump sum money, and then you need to select a target fund, which needs to be of the same AMC, right? How do you do this selection?
Yeah, so first, you choose the equity scheme. So I would say if somebody is looking at an investment for a long-term horizon, you don't look at saying, okay, which liquid fund is the best and I will move money from there. You see which equity fund suits you, whether it's a large cap fund, whether it's a passive fund, whether it's a small cap fund, whatever the fund may be. Once you've chosen your scheme, and in that same AMC, you choose a liquid fund because that's the one where there will be the least amount of risk. The target scheme will be your equity scheme, and the scheme in which you invest has to be a scheme which absolutely has less or no volatility, right? Because you don't want this fund to keep fluctuating, because from this money is going to go into equity. So you want this to be as stable as possible. In this scheme, you're not investing for returns. You're investing it just as a wire media for your target scheme. So the equity scheme should be chosen first. And because of that equity scheme, then you choose whichever is the lowest, low volatility scheme, low debt, low target maturity, and you will invest in that. So usually that's a liquid fund. So you can just do an STP from there.
One very basic question that investors often ask us: why a liquid fund? Why can't it be our savings bank account? I mean, it's just about giving a mandate, right, of an SIP, okay? That can be given through a savings bank account also. We can have an ECS facility done to a particular fund where we want to park in the money. Why to make use of a liquid fund?
So two things. One is definitely if there is a lump sum amount sitting in the bank, you can definitely do an SIP. No problems with that, except for the fact that if money is sitting in the bank, we tend to spend that money or use that money for something else other than what we actually intended for, right? So it's like whether there's a sale going on, whether it's somebody who needs that money, whether it's a family member who needs that money. If not, the bank RM will connect with you and tell you where you can use that money or invest in someplace else. So what you actually intend for that will not be met. That's the first reason. And the second reason is your liquid fund will give you slightly higher returns anyway from the bank account that you would have put this in. So there are two big reasons for you to do when there is a lump sum, an STP instead of an SIP.
Now, Shweta, you are parking your money in two type of funds, okay? Let's assume that liquid being a fixed income and the other choice of fund that you want to invest is an equity fund. Could you explain the taxation? Okay. For example, someone has a lump sum of, say, maybe a lakh, okay? And you want to do it like in 5 phases. You have to stagger it out. What will be the duration in which for liquid fund in which you need to park that money, and then when the money is going to your equity fund, what will be the tax liability from the exit on a liquid fund?
So that's a great question because people usually do worry about the tax part. So whatever you're earning on liquid fund, you would be paying taxes on that. It'll be just added to your income because it's short-term debt. So it will be added to your income and you will be taxed according to your tax slab. So that's the taxation on the debt part. On the equity part, of course, on entry, you're not taxed. Whenever you exit at that time, whatever applies, that will apply at that time, whether it's short term or long term, and at that time, what the tax regulations are. But for debt, if you're doing this now in the next 5-6 months, like you said, 5 installments, and if you're doing 1 lakh and you're doing, say, 20,000 in each installment, the last installment will probably be 20 plus a little something because you would have gained something on the entire amount. And you would need to pay whatever on gains. So say if you've earned 500 rupees, for example, then that will be added to your income, and in your according to your tax slab, you will be taxed.
Okay. Now, Shweta, do we need to have liquid fund and a target fund from the same AMC? What if we want to stagger this 1 lakh rupees across fund houses? Is that a good strategy?
So you will need to do this in the same fund house. If you want to do different fund houses, you will need to invest in the liquid funds of 2 different fund houses. And from each of them, they will move to their respective equity funds in their AMCs. You cannot do STP across AMCs.
One last question, and then we slip into a break, and then we have viewers also joined up to ask you their financial portfolio queries. But then, talking about STP, how exactly? What's the time frame you should be phasing out your investments into?
So like I said, if somebody is a new investor, 6 to 9 months is a great time for them to slowly ease into equity. But if you're more wary about the market conditions or economy and say, okay, this is the only money that I will be receiving for the next 1 year and I will not be investing anything else, then you might even stagger it up to 12 months. But usually what we see is because there is a lump sum available, people get really antsy and they want to get invested as soon as possible, especially if markets are moving upwards. They feel that they've lost out. So 6 to 9 months is a great idea. What also happens is if somebody's staggering it for, say, 6 months and there is a bit of a big correction in the meanwhile, you could potentially move the rest of the money at whatever time you choose to. So if there is a huge correction, you could do that as well. So 6 to 9 months, I think, is ideal.
Have trigger SIP. Is there something called as trigger STP also, because you see the market movement and then you decided to put the money or not?
So some funds do have, but usually you would want to do this not with the trigger STP, but some funds do have. Most funds do not have.
Right, so this was all about systematic transfer plan that you needed to know, and if you are someone who's been timing the market, well, you have something called a systematic transfer plan which you might need to adopt as a strategy in your portfolio. But then let's slip into a short break. I have Shweta Jain connected with me, and then we'll be connecting our viewers online and getting their live financial planning done. But then if you are someone who has a lot of questions on their mutual funds portfolio, do send us your question on our WhatsApp number, which is 865-797-4571, and you can also email us your questions on the Money Show at etnow.tv. See you after this break.